All right, everyone, let's go ahead and get settled in. Welcome to today's lecture. I am so glad you're all here for this explainer on the Vietnamese enterprise accounting regime. Today we're going to be tackling a really foundational piece of the puzzle, Chapter 5, specifically looking at owner's equity, under Circular 99/2025. So grab your notebooks, get comfortable, and really focus in. I'm going to take this nice and slow today, making sure we thoroughly break down these core principles, because honestly, these concepts are going to define your future careers as professional accountants. Okay? Let's dive right in.
Here is a quick look at our syllabus for today's session. 1. We'll start by decoding owner's equity. 2. We'll dig into Account 411, investment capital. 3. We'll navigate the tricky waters of treasury shares. 4. We'll look at undistributed after-tax profit. And finally, 5. Distributing the profit.
All right, moving right along to Part 1, decoding owner's equity. Let's start with the absolute basics.
I really want you to notice that phrase, indefinite term capital. When you're looking at the right side of a statement of financial position, you've got your liabilities and your owner's equity, right? Now, liabilities are debts. They have a strict maturity date. The bank or the creditor can and will demand their money back. But owner's investment capital, that's entirely indefinite. An owner can't just walk in and withdraw their capital whenever they feel like it, the way a creditor can. The only way they see a return on that initial investment is either through periodic dividends over time or by claiming whatever residual value is left if the company eventually dissolves. It's permanent capital.
Because of that, we have this absolute golden rule from Circular 99/2025, record only actually contributed capital, not committed amounts. Listen closely, class, because I literally cannot stress this enough. This is a huge trap on your exams, and honestly, it's an even bigger trap out there in professional practice. Say an investor signs a legally binding document, committing to contribute 500 million dong, but they only actually transfer 300 million to the bank account. Well, you only record 300 million. Accounting is entirely about economic reality, not just empty promises.
Let's move into Part 2 and look at the star of the show, Account 411, investment capital.
Account 411 is massive, but thankfully it's neatly organized into 4 very specific sub-accounts. First up, 4111. This is your contributed capital strictly at par value, the official charter amount. Next is 4112, the share premium. This catches any difference between the actual issue price and that par value. Then we have 4113, which separates out the equity component of convertible bonds. And finally, 4118, which is other capital. As we'll see a bit later, 4118 plays an absolutely crucial role as a sort of interim holding area. Now, before we start writing out journal entries, let me throw a question out to the class to challenge how you think about this. Are preference shares always considered owner's equity? Now, legally speaking, the word share is right there in the name. So your gut instinct might be to just say, well, yes, obviously. But remember, as future accountants, our job is to look much deeper than just a legal label.
This brings us perfectly to the core principle of substance over form. Under Circular 99/2025, preference shares actually have to be classified as liabilities if they meet certain criteria. If they have a mandatory redemption date, or if they demand a fixed dividend payout, even if the business is losing money, or if they have variable share conversion terms based on market price. Well, think about it. If a share forces your company to pay out hard cash on a rigid schedule just like a bank loan does, then economically, it's a debt, period. And we absolutely must account for it as a liability.
Let's apply this to capital contributions in a limited liability company. You have to be super careful to distinguish between 2 totally different scenarios here. Situation 1 is an intentional difference by agreement. Let's say all the LLC members agree that one specific person will pay a little extra upfront just to give the business some initial working capital. That intentional excess? Perfectly fine. You safely record that in Account 4112, share premium. But look at Situation 2. A shortfall due to an incomplete contribution. A member just straight up misses their deadline. That is a breach of contract. And going back to our golden rule from earlier, unfulfilled commitments never touch Account 411. You do not record that shortfall anywhere in equity.
For joint stock companies, the scenario you'll see most often is issuing shares above par value. The mechanics here are actually beautifully logical. You're going to debit your cash account, so 111 or 112, for the total amount of money you actually received. But you have to split that credit. The strict par value portion goes directly to Account 4111, and every single dong above that par value, the excess, gets credited to Account 4112, share premium. It's crucial to always keep par and premium in their own separate lanes.
All right, moving to Part 3, navigating treasury shares. This is where we look at Account 419.
Okay, here's a definition you absolutely need to commit to memory.
Treasury shares, which we track in account 419, are simply a company's own previously issued shares that it went out and bought back. Now, because the company spent actual cash to buy these shares, people constantly make the mistake of calling them an asset. Let me be clear, it is absolutely not an asset. You literally cannot own a piece of yourself to generate future economic benefit. That doesn't make sense. Account 419 carries a debit balance, meaning it shows up as a negative number on your financial statements, directly reducing your total owner's equity.
Let's look at a concrete example from the text, Hai Long JSC. When a company buys back its shares, what value do we actually plug into account 419? Do we just use the par value? No way. Account 419 is booked at the actual historical repurchase price plus any direct costs you paid to acquire them. So in this case, 100,000 shares repurchased at 22,000 dong each, plus 5 million dong in broker or transaction fees. You do the math, and we debit account 419 for exactly 22,050 dong per share. It's purely based on what it cost you out of pocket.
So, once your company is holding these treasury shares, they really only have two possible fates. You can either cancel them or resell them. If you cancel them, it permanently shrinks your charter capital in account 4111. If you resell them, well, it brings fresh cash back into the business. But here's the catch. In either scenario, the price you originally paid to repurchase them is rarely going to perfectly match the par value or the new price you sell them for. There is going to be a difference. And the strict accounting rule here is, both of those differences, whether a gain or a loss, are routed exclusively through account 4112 share premium.
Which brings me to a rule I want you to literally double underline in your notes right now. Differences from treasury share transactions are absolutely never recorded in account 711, other income, or account 811, other expenses. If you turn around and sell a treasury share for more than you paid for it, that is not accounting income. Why? Think about it. A company transacting with its own current owners does not magically generate economic profit. It just shifts equity capital from one bucket to another. Recognizing that as income from yourself would completely misrepresent the income statement to investors.
Okay, part 4. Undistributed after-tax profit. This is the fun part, the reward phase. Account 421 is elegantly split up to manage different time frames. Subaccount 421-2 tracks the profit or the loss that the business generated purely in the current accounting year. Meanwhile, subaccount 421-1 holds the historical stuff, all the accumulated undistributed profit from every prior year combined. So the essential mechanical task for you as an accountant happens right at the year opening. Bright and early on January 1st, you have to manually transfer the final balance from last year's 421-2 over into 421. You're effectively clearing the slate so the new year's performance can be tracked cleanly.
And finally, part 5, distributing the profit. How do we allocate that hard-earned month? Once the general meeting of shareholders meets, they have a few different avenues for distributing that profit. They might decide to retain it internally by appropriating reserves. For example, moving funds into the Development Investment Fund under account 414, or maybe the Bonus and Welfare Fund in 353. Just keep in mind, those reserve rules are heavily dictated by the company's specific charter. Alternatively, they can return the profit directly to the owners. They can do this via cash dividends, which run through account 332 as a payable, or through stock dividends, which take a little detour through account 4118.
Let's talk timing, though. When do we actually book that cash dividend? The rule is, dividends are recorded in account 332 only when the enterprise no longer has the right to refuse the payment obligation. A casual chat in the boardroom? Not enough. A drafted proposal? Still not enough. You need the actual legal formalization, a past, fully effective resolution. Only at the exact moment the company is legally bound and cannot back out do we actually recognize that liability on the books.
Now, stock dividends, also known as bonus shares, they require a very strict two-step accounting process. Step 1 triggers when the official decision is made. You reduce your retained earnings by debiting 421, but you do not credit your charter capital yet. Instead, you credit account 4118, other capital. Step 2 might happen weeks or even months later. It happens the moment you physically receive the updated business registration certificate back from the government. Only then do you clear out 4118 with a debit and officially credit 4111 contributed capital.
I want to pause for a second here. I want you to really think about the logic behind this rule. Why do we have to force this transaction through account 4118? Why would we just immediately credit 4111 the second the board says, hey, let's issue some stock dividends? Think about the tension here between legal reality and economic intent.
And here is exactly why. Account 4118 essentially functions as a waiting room or a legal holding area. You see, a company simply cannot legally claim to the public that its official charter capital has increased until the state formally stamps and validates that updated registration certificate. During that waiting period, yes, the funds are economically committed, but they are legally ineffective as formal charter capital. So Account 4118 beautifully bridges that gap. It keeps our financial statements 100% legally accurate while the paperwork catches up.
Which perfectly brings us to the end of our session today. I want to leave you all with a final, somewhat provocative thought. As you step out into the real world as future accountants, are you just going to be bookkeepers who merely record legal labels? Are you going to just see the word share on a piece of paper and blindly record it as equity? Or will you really internalize Circular 99/2025, look past the surface, and uncover the true economic substance of the businesses you're analyzing? Because at the end of the day, true accounting is about reporting economic reality. Thank you so much for your focus today, everyone. Keep studying hard, review these notes, and I will see you in our next explainer.